There's a frustrating reality about being a high income earner. No matter how much you earn, there's not a lot you can do to reduce your tax bill. You earn the income, you pay the tax. That's it. It's the same for the highest paid CEOs in Australia. They all pay a lot of tax. My name's Ben Elliott. I'm an accountant and business owner. And over the last 13 years, I've worked with hundreds of clients trying to solve this exact problem. And there's one strategy that actually works for wage earners. It's called debt recycling. What's great about this strategy is that it doesn't just save you tax, it also builds an investment portfolio at the same time. So you're doing two things at once. In this video, I'm going to walk you through exactly how that works, who it's for, what you need to have in place, and the numbers behind why it actually works. Let's get into it. Now, before I explain how it works, let me tell you who this is for. Debt recycling is for high income wage earners who have three things. First, you've got a mortgage. Second, you want to reduce tax. That's obvious. And third, you've got spare cash flow. This is the important one. You need to have extra cash each month that you're putting away into your mortgage or sitting in an offset account. If you don't have spare cash flow, this strategy won't work because the whole strategy relies on you being able to pay down portions of your mortgage quickly. If you have those three things, here's the problem you're likely facing. You've got a mortgage, let's say it's $1 million for this example, and every month you're paying interest on that mortgage, but the interest is not tax deductible. Now, why isn't it tax deductible? Because the loan was used to buy your home, and your home is a personal asset, not an investment asset. The ATO doesn't let you claim deductions on personal expenses. If your loan was used for an investment property or any other investment asset, you'd be able to claim interest on that loan as a tax deduction since you're using the asset to produce income. Now, let's say your goal is to eventually start building an investment portfolio. But to do that, you'd need to save up cash separately. And that cash is also coming from after-tax dollars. So you're stuck. You're paying down the mortgage, but you're not building any wealth outside of your home. And you're not getting any tax benefits along the way. What if we could flip that? What if we could turn that non-deductible mortgage debt into tax-deductible investment debt? And what if we could build your investment portfolio at the same time? That's exactly what debt recycling does. Let me walk you through this step by step. The first step is to split your mortgage into separate accounts. I'll use the $1 million mortgage example. What you're going to do is you're going to split it into 5 separate sub-accounts of $200,000 each. Now, why are we doing this? Because we need to keep the deductible debt separate from the non-deductible debt. Think of it like this. If you had one big $1 million loan and you paid down $200,000, then we drew that $200,000 to invest, the tax office would see that as a mixed purpose loan. Part of it was for your home, part of it was for your investment, and when it's mixed, they don't let you claim the full tax deduction. But if you split it into separate accounts, each account has a clear purpose. This account is for the home, that account is for investment. There's no mixing and the paper trail is clean. That's why we split it. And most banks allow you to do this. They're all pretty flexible. So now, instead of one big $1 million loan, you've got 5 separate $200,000 loans. Functionally, nothing has changed. You're still paying the same interest. You're still paying the same total amount each month. But now we've got separate accounts that we can work with. The second step is where the strategy kicks in, because here is where you're going to take your spare cash flow and you're going to direct it all towards that first $200,000 loan. Your goal is to pay it down as quickly as possible. Now, don't pay it off completely. If you pay it off and close the account, you lose the ability to redraw. So you pay it down to a very small amount. I normally say $1. Once that first loan is sitting at $1, you can move on to the next step, which is you redraw the full $200,000 and you invest it. Now, you could have put that surplus cash into a savings account, wait for it to accumulate, and then use that cash to invest. But that money would be sitting there earning minimal interest, getting taxed, and not really doing much for you. But if you're paying down your mortgage with that same cash, you're saving interest on your home loan. Then, once you've paid down the full amount, you redraw it, invest it, and now the interest on that loan becomes tax deductible. So you've taken a $200,000 portion of your non-deductible debt and turned it into tax deductible investment debt. Now you move on to the second $200,000 loan. But this time you'll be directing any of your extra cash into that loan, plus the earnings from the investment portfolio you just set up. So you'll likely end up paying it down faster than you paid down the first one. Again, once you get it down to $1, you redraw the $200,000 and add it to your investment portfolio. Now you've got two loans that are tax deductible and a $400,000 investment portfolio. And you just keep repeating this until you've turned your entire $1 million non-deductible mortgage into tax-deductible investment debt. And you've also built a $1 million investment portfolio. I'll put this into perspective, how much money this could end up saving you in the long run. Right now, if you've got a $1 million mortgage at 6% interest, you're paying $60,000 a year in interest. That interest is not tax deductible. If you're in the top tax bracket, which is currently 47%, you need to earn around $113,000 in pre-tax income just to pay that $60,000 interest bill. Now, let's say you've completed the debt recycling strategy. You've still got the $1 million in debt, but now it's investment debt. That $60,000 in interest is now tax deductible. At 47% tax rate, that's a $28,000 tax saving every single year. That's money you can reinvest, pay down other debt, or use however you want. But here's the other side of the equation. You've also got a $1 million investment portfolio. The 100-year average return for Australian shares is 10%. US shares is slightly higher. So let's be conservative and say you're earning 8% on your portfolio, and that's $80,000 a year. You're paying $60,000 in interest, but you're earning $80,000 a year in investment returns. That's $20,000 net gain before tax. And remember, the interest is tax deductible. But here is the part that most people miss. If your portfolio earns 8% a year, most of that return is capital growth, which is not taxed as it happens. Using the same $1 million example, that is roughly, say, $50,000 in capital growth and $30,000 in dividends. $60,000 in interest costs, giving you a taxable loss of $30,000, which leads to a tax refund of about $15,000. So when you add it all up, your net gain for the year, including the tax refund, is about $35,000. So that's how the strategy works. But before you go out and do this, you need to understand something important. You're taking on risk. And I don't mean in a scary way. I just mean you need to know what you're getting yourself into. First, you're keeping debt. You're not getting debt free. You're converting your debt from one type to another. For some people, that's uncomfortable. They want to pay off their mortgage and own their home outright. And I get it. If that's you, this strategy probably isn't for you. Second, you're investing in the share market, and the share market fluctuates. Some years you'll get great returns, other years you'll get nothing. Some years you might even go backwards. That's just how it works. Over the long term though, the numbers work. The 100-year average for Australian shares is about 10% per year. US shares are slightly higher. But in any given year, it's unpredictable. So you need to be comfortable with that. This is a long-term strategy. It's not something that you do for 2 years and then decide to pull the money out. You're locking that money into investments for the long haul. Third, there's the risk of getting it wrong. If you don't set this up properly, you lose the tax deductibility and then the whole strategy falls apart. So you need to make sure it's structured correctly from day one. Because you're taking on these risks, you need to make sure you've got the right team around you and you're doing this properly. First, you need a good mortgage broker. Not all banks are set up to do this easily. You need a broker who understands debt recycling and can get you set up with the right loan structure. You need to make sure the sub-accounts are created properly and then the bank won't close them when you pay them down. Second, you need to know how to invest. Now, this is where a lot of people get stuck. They understand the debt side of the strategy, but they don't know how to invest the funds. You need a clear investment strategy and you need to know which assets make sense for the long term. And if you don't know how to do that, you need a financial advisor like us who can help you set up your portfolio that matches your risk profile and your time horizon. The key is making sure you're investing in quality assets that you can hold for the long term. And third, you need discipline. This isn't a set and forget strategy. You need to keep paying down those loans. You need to stay on top of it. If you get lazy, the strategy stalls. And you need spare cash flow. If you're already stretched paying your mortgage, this won't work. You need extra cash each month to accelerate the pay down of those loans. So this isn't for everyone. But if you've got the cash flow, the discipline, and the right team around you, it's one of the most powerful strategies available to wage earners. So if this sounds like something that could work for you, and you want to find out whether debt recycling makes sense in your situation, book a call with us. We'll sit down, look at your numbers, and work out whether this strategy is right for you. Links in the description below. I'll see you in the next one.